Imagine waking up to see the stock market down 30% overnight, banks limiting withdrawals, and grocery prices rising faster than you can keep up. Sounds extreme? Maybe. But some economists believe the world is closer to this reality than we think. Today, we're going to break down the warning signs of a potential global depression in 2025, the kind that could rival the 1930s. I'm not here to fearmonger. I'm here to connect the dots between debt, interest rates, geopolitics, and AI disruption, and show you what you can do about it. Right now, the global economy is in a strange place. Debt levels are at historic highs. In the US, national debt has passed $34 trillion. Many advanced economies are carrying debts over 100% of their GDP, levels not seen outside of wartime. Inflation has cooled since the post-pandemic surge, but it's still stubbornly above pre-2020 averages. For most people, everyday costs, food, housing, energy, are still noticeably higher than just a few years ago. Central banks like the Federal Reserve and the European Central Bank have slowed interest rate hikes, but they haven't slashed rates either. That's partly because they fear cutting too soon could reignite inflation. Add to that geopolitical tension, the Russia-Ukraine war, strained US-China relations, and supply chain fragmentation, and you've got a global economy that feels fragile. So why are some experts worried this could snowball into a depression, not just a recession? First, debt bubbles are everywhere. We've got overpriced real estate markets, over-leveraged corporations, and consumers racking up credit card balances at record interest rates. Second, consumer confidence, the heartbeat of the economy, is slipping. Even with relatively low unemployment, people are tightening their wallets because they feel uncertain about the future. Third, trade fragmentation is accelerating. Countries are friendshoring, moving supply chains to politically aligned nations, which may be safer politically, but it's more expensive and less efficient. The scary part? History has shown that when you combine high debt, weak consumer confidence, and trade disruption, you get conditions that look a lot like 1929 or 2008. But there's one big difference this time. We're entering the first potential depression in the age of advanced AI. AI isn't just changing factory floors, it's transforming offices, law firms, design studios, and even software development. Jobs once considered safe, especially white-collar roles, are now being automated faster than anyone expected. While AI can boost productivity, that doesn't necessarily mean higher wages for workers. If middle-class incomes stagnate while living costs stay high, consumer spending, the engine of modern economies, slows down. And when consumer spending slows, businesses cut back, which leads to layoffs, which leads to even less spending. That's how economic slowdowns turn into depressions. So what could actually tip us into a global depression? Economists point to three main triggers. A sharp credit crunch. If interest rates stay high and banks pull back on lending, small businesses and households could run out of accessible credit. A major geopolitical shock, a sudden energy crisis, escalation in conflict, or a new pandemic could hit global trade hard. Emerging market debt defaults. Many developing countries borrowed heavily during the low-interest years, and now repayment is becoming impossible. A wave of defaults could destabilize global banks. The dangerous part is the feedback loop. Once fear takes hold, investors sell, markets drop, companies cut jobs, and the cycle feeds itself, just like in the Great Depression. If you're wondering how to spot trouble before it hits, here are 4 key warning signs economists are tracking. Yield curve inversions. When short-term interest rates are higher than long-term rates, it often signals a coming downturn. Commodity price spikes, especially in oil and food, which can reignite inflation and hurt consumers. Sharp drops in consumer spending. Retail sales data is one to watch. Tightening credit. If banks are lending less and rejecting more loan applications, that's a red flag. So, what can you actually do? Diversify your income streams. Don't rely on a single paycheck. Side hustles, freelancing, or small investments can cushion shocks. Build an emergency fund. Even a few months of living expenses can be a lifesaver. Reduce high-interest debt. Credit card balances can be devastating in a downturn. Stay informed without panic. Fear-based decisions often lead to bigger mistakes than the downturn itself. The truth is, no one knows for sure if we're heading into a depression. But by understanding the risks and preparing now, you're in a far better position than those who ignore the signs. If you found this breakdown helpful, hit like, subscribe, and share, because the best protection against uncertainty is knowledge.